Good morning, traders. Welcome to another Flow Show. We write Tuesday, 11th of March, 2025. Um, First of all, I just want to make sure that this is streaming, so I'm going to ask some of my colleagues whether it's an issue with Twitter or X again, since they had some issues yesterday. Um, just to know whether I'm streaming or not, and I may need to do something um, to remedy to it if I'm not if we're not streaming. But anyway, let's dig into what has happened yesterday, overnight, this morning. Just before we start, just want to remind you, and we had a few questions on our Twitter handle and other media venues where people were asking us about opinions about where they could join us. So if you want to try us out, it's just $1 for 10 days. You can join our community where you have not only us in the team, but a whole host of like-minded traders just ready to help each other out on whether it be on FX, whether it be in equities or anything else having to do with fundamentals or so. It's really a big community. Um, okay, Patrick, thank you very much. And Brand, thank you. I just wondered whether I was streaming on other venues, but okay, no, never mind. So yes, just a reminder that you can join us for really as little as $1 for 10 days to come and try us out. That being said, let's move on to what has happened overnight. And yeah, as Brand was already saying, it's been a really big headline on the geopolitical front again yesterday and overnight. It's just incessant right now. We know that today there is this meeting ongoing between the US and Ukrainian delegation in Saudi Arabia. That meeting is ongoing. The Russian have already replied that Ukraine's missile attack overnight or drone attack overnight, was not really of the likes of helping the process of peace. That they will hear from the US whether the Ukrainians are ready to for any kind of deal. It had been said that there may be in Western media that came out that there may be discussions surrounding a 6-month truce or so, but the Russians are refusing to make any comments regarding that, and they are waiting for what the United States delegates are going to tell them once those meetings are done. So we will be on the lookout for headlines over the course of the day to see whether there is any advance in those talks. Staying on the geopolitical front, but then moving over to China, they have also increased tariffs on some US products, and there were some interesting headlines yesterday as well. Actually, one of the Chinese press media came out saying that there may be a meeting coming between Trump and Xi as early as April, but then later on, the Western kind of press, some of the Western outlets said that that meeting may not happen before the month of June. So that, for anybody who's watching, of course, geopolitics is going to be a very important one because they are, or they were, or they still are in a way, very, very big trading partners, China being one of the main trading partners of the whole world. So those talks or potential talks coming in will be of utmost importance, obviously. Staying in China, sorry, they are going towards the end of their 2 sessions there, and they came up with a plan to inject another $42 billion worth into consumer-led programs. They are really trying to get their act together, get their economy back on track. So they are spending more money. There are already been rumors that there may be another RRR cut coming as well from China once the two sessions will be over dusted with, and we get all the official comments coming out of those two sessions. So that's a story we also will keep a close eye on there, because um, regarding those programs, it may be very positive. But if in the meantime the PBOC continues to inject liquidity, continues to cut rates, it may have a bit of a temporary adverse impact on the Chinese yuan. We will have to, as I already said, start to really look carefully what PBOC is going to fix in the onshore Chinese yuan, to have an idea whether they want to keep the yuan inside a range. They have the means to do so, and or whether they now, once they are revamping their local economy, trying to devalue is a big word, but try to guide the Chinese yuan perhaps a little bit lower to spur the rest of the world, if not the US, to continue to buy their goods and their manufactured products. Right, staying on the geopolitical still, Muto, Japan's trade minister, was in Washington yesterday. He said they had very thorough talks with the US, but for the time being, he did not receive, although some sources were kind of hinting at Japan perhaps being let off from all the tariffs, but he said he did not yet receive any assurance that Japan would be completely safe of tariffs. So that is something that is pretty important for the Japanese yen as well. I'll have a look at the Japanese yen, because there were a couple of counterintuitive moves that we saw last evening and overnight. But so this is not yet done. We also had comments regarding the Bank of Japan. One of the ex-members, Momo of the Bank of Japan, said that he expects the Bank of Japan to move on rates only in June. So not really the May meeting, but it would rather be in June. It is obviously personal opinions. We have seen that Ueda has already surprised the market with that last rate hike coming a little earlier than what the market was expecting. I still think there is a pretty decent chance that we could be in for May, depending on how the wage talks will go, and if those numbers that I'm just highlighting here would actually turn around a bit, because if you look at the data in Japan, they were not really of the likes of spurring the Bank of Japan with early rate hikes. The household spending was much lower than expected. We've talked about that bonus spending in December and perhaps seeing a setback in January. Well, it's been a bigger setback than we may have expected. We also have the fourth quarter GDP numbers coming out, and where the GDP is still a little higher than in Q3. It came in a little under expectations for Q4, but where it's not really good here is still that private consumption, all in all, in Q4, not really following the path that Bank of Japan would like. Of course, the inflation-driven measures, they have been printing higher. We have seen that already in the Japanese and the Tokyo inflation data, so that should not come as a surprise. The surprise here, and what needs to be remedied to, is really the spending in Japan. We need higher wages there. We need the Japanese consumer to feel at ease with everything that's going on in her own country, and for those numbers to remain in the positive territory. Okay, right. Moving on. Yeah, there's been a couple of central bank speakers as well. Nagel yesterday was a bit vague about his plans. He said they will be data dependent, and they will see what needs to be or what will be done on the defense spending side to make further decisions. And quite interesting, about an hour or so ago, we had ECB's Ren, one of the hawks actually, that came out with a line saying that the higher defense outlays in Europe won't necessarily slow ECB cuts. And that's an interesting one coming from him, because he's usually, as I said, one of the hawks, not in a hurry to cut. But him saying that, I think, tells us that no one at the ECB would like to hike rates anymore. Okay, I mean, it's not because the yields are being dragged higher for the reason of this defense spending in Germany especially, but pan-Europe as well, that the ECB is necessarily wanting to hike rates because of the yields are going higher. We have already discussed that in length, but just wanted to reiterate. In my personal opinion, if yields would rush away in a bit of a panic kind of move, the ECB may rather step in and buy European government bonds instead of needing or feeling the need or coming up and saying we need to hike rates to counter this yield move. It's a different kind of move that we are seeing in the yields right now. Okay, it is spending. We have seen that elsewhere as well. When the spending rushes away, the yields are going higher, and it was one of the reasons that the market was giving as well for the Fed to stay put. But they have other things that they are looking at, and if growth does not really follow all this spending very rapidly, there is absolutely no need for the ECB to hike rates right now. So the response to those higher yields will likely come in the form of, well, what I think anyway, that's my personal opinion, in the form of European government buying, perhaps. Okay, staying on the spending thing, we had a bit of an episode yesterday, which is going to continue until a deal is reached or goes bust in Germany. So first of all, we had the AfD going to court to try to delay. Well, they said that the old Bundestag shouldn't be deciding upon new rules and new spending. So they want to go to court and really delay everything until the new Bundestag is in place. But if they do so, if they succeed, if the court would go their way, that would mean that current deal process to get that spending on the road and to get that voted in would be delayed until the new one, and we would be going past the deadline of the 25th of March, which would be very, very bad for potentially for getting a deal, because that just increases the uncertainty, and AfD and some of the other parties may all of a sudden have a blocking minority, and this deal not going through at all. So the Greens have been then yesterday adding fuel to the fire, and first of all said that they could not accept the deal in the form that it was because there was not enough green in there. But then they came out twice, once yesterday already, and then just early doors this morning as well, that they really want a deal done, and possibly before the end of this week. So that is putting it back onto the table. And if they get a deal done, we know that the two parties in Germany will need the Greens to have this majority. So the Greens are very, very important in this play. If they get a deal done, then this court case for the AfD will be obsolete and actually worthless. Okay. What else? Oh, yeah, yesterday and overnight there were some lines again, and we are seeing that the Canadian dollar is remaining under the cush. The Alberta Premier slapped some tariffs on exports to the US as well, and Trump came out overnight and said that the US no longer needs the Canadian energy, lumber, and cars, and he will end subsidies to the Canadian economy. So that is keeping the Canadian dollar under the cush. We see the dollar versus Canadian dollar not moving too much right now. So Carney's got his work cut out to try and mend the pieces if he already would want to. So that's another one that is still totally up in the air, how it goes between the US and Canada. Something tells me that the next week and a half will be quite important. We know that there is this 2nd of April deadline looming because the US is still crunching numbers as to who is putting VAT, who is putting tariffs for those reciprocal tariffs. But in the meantime, I do think with those incessant lines coming in, hints coming in at what could happen or not, I guess the next week and a half, we are going to hear a lot of maybe even decisions on everything tariff related or even geopolitics actually, as we see now that the US is talking to Ukraine. Right. Lastly, on the headline fund, and I'm coming now to Europe because we had two movers. We have seen two currencies that been moving quite a lot over the past week and a half as well, and actually for the Swedish krona case already for longer. The Swedish Riksbank Tidin came out today on a bit of a positive note. We have seen those Swedish central bankers and officials being relatively dovish and bearish on their own economy for the better part of 2024. But now Tidin came out saying that he sees positive signals based on what the economy had been doing, the better numbers that are coming out of Q4 2024. Excuse me, but we're already March. But he did say that the 2025 signals are a bit more mixed, but he came over relatively optimistic on the Swedish economy. As I've already been saying a number of times, the Swedish krona, Europe being their main, by far, trading partner, is a bit of an accelerated euro. So we have seen this morning again, the Swedish kroner gaining a bit of strength on the back of those comments. But in the meantime, with this little setback that we have seen on the euro, the Swedish kroner is giving some back. But there are some things perhaps moving here on Swedish kroner, but it will depend now, as all the central banks are, obviously. But I'm starting to pay a little bit more attention to what's happening in Sweden, being this close to Europe. If we would see some green shoots over there, the Swedish krona could appreciate. But I think that what I think at least is that the Swedish krona has done the best part of its move already, because we saw really big accelerations on the stronger side of the Swedish krona. And then over to its cousin, the Norwegian krona. We had the finance minister Stoltenberg out this morning saying that the CPI data that we have seen in Norway, and we saw those data, we spoke about it yesterday briefly, that the CPI data in Norway showed the need for a prudent policy. He still thinks that the inflation remains on an overall declining trend, but he says that they will have to be a bit more prudent. But the Norges Bank is independent, but they have very, very close ties to the Ministry of Finance as well, because they have like these joint deals on oil and all those remittances and stuff. So his voice will be heard. Okay, so we need to be a bit careful with the Norwegian kroner as well, because it could mean that Norwegian central bank may be slowing down a little bit. We do know that they buy Norwegian kroner every day, but they are not really massive amounts. So if there would be a bit of more strength coming through in the Norwegian kroner, I would not be surprised from here. It's going to need a bit of a slow down in the decline of the oils, but I think it is possible, because we are in pretty decent areas in those energy products. As a matter of fact, today we have seen Brent oil, which is the Norwegian exporter product, regaining some strength, and the Norwegian kroner gaining some support with it. Okay, over to the data before we are going to have a look at the at what's happening in markets. So I already spoke about this the Japanese data. We had a few auctions. It's a decent auction week in the US as well. So keep an eye on how those auctions go. I mean, the 3 6 months is not something that I really bank on, but we do have a little bit of further out auctions as well this week. So keep an eye on those as well. Yesterday's employment trend index was okay in the US. We actually had a little bit of a better revision as well, a point higher. This comes in a bit in contrast with some of the employment numbers that we have seen, but this one says nothing completely wrong yet after the last week's employment report. Retail sales monitor a little lower in the UK, but we have seen other reports where the UK consumer is still doing pretty okay. So that has not really impacted the sterling too much, although it did keep the sterling a little bit subdued, but that is versus that euro wrecking ball that we are having right now, okay? Mainly because if you look at the sterling versus other crosses, it's not really um, um, going down much. Any big business confidence in Australia still um, lagging and not really jumping too much higher. The business survey was a little bit better, but the confidence number, and we know that confidence is a big driver of what's going on right now in all markets. That is still well, again, showing a negative number after a pretty good jump last time. I'll have a look at the Aussie today as well because it's still such a laggard on all the other currencies. It's a bit strange actually, in my opinion. But anyway, what else? We had this a little bit lower small businesses optimism compared to the better one yesterday on the employment index. The small businesses, we have heard on those prior challenger layoffs that the retail market was not doing very well, and this may be a reflection of that as well. So there may be a bit of a disjoint between the bigger businesses and the small businesses in the US. But anyway, it's coming in a little lower. What's happening today? Jolts. Okay. It has been a bit jumpy. I think now we had the NFP already report. Not sure that this is going to be really a big mover today, but it will, whatever happens, create an algo move, especially with the markets being on their toes as they are right now. And then, as I said, a bit longer term out, we have the 3-year note auction coming out later today. What else do we have next night? No, tomorrow really we start with the big ones. We have tomorrow we have the US CPI data out. So really from tomorrow we're going in the thick of the data week this week. Okay, right. What everybody wants to know is what's happening to the markets. And I'm first of all going to show you, and I'm going to go back on this one. Um, I I usually look at differentials, okay, and the one that is the biggest driver, dare I say, in markets are the differentials between the short end euro and the short end euro dollar, that correlation, and the dollar here and the euro dollar correlation. We can also look at the 10 years. It's been going exactly the same direction, okay, but for the ease of what's going on here. Um, I'm going to show just the short end differentials. And there's a reason why I look at those differentials, okay? After a period of give and take, when we turned around 102, 105, back down to 103, then a little bounce, then coming back down. And then we had this move here starting, okay? And what happened, especially over the last week or so, is an acceleration in the differential. So just for those who are not familiar with this kind of chart, the EU, the EU yields are lower than the dollar yields. So, okay, so if this goes down, that means that the differential from the US over the EU yields is going higher, okay, is widening. The differential is widening, so that is usually a bit negative for the euro dollar. And when the differentials are tightening, as you can see, we are coming from 225 BPs at the start of February. Then we moved towards the end of February, and this is where the thing really took off. We're starting from 200 BPs. We are now trading at 168 BPs. So that's a tightening of the spread between the EU yields and the US yields. And look what's happened to the euro dollar, okay? We are still trading yields when it comes to the euro and the dollar. We are still trading yields. The reasons behind may largely vary at points. And really, I mean, there's a lot going on. And obviously, there is a reason why the euro yields are going up now with all this defense spending and yeah, the need for funding those. But there's also kind of like a positive effect that is coming out from Europe saying, or positive vibe that is coming from Europe saying that, okay, Europe is getting its act together. So combine those two, we went completely back onto the yields bus where US yields are reluctant to get back higher. We have seen here the US 10s, for instance, are reluctant to go back higher. But if you see the German 10s, for instance, they've put in a big jump. These ones I've been talking about as well, they reflect rather the lack of confidence that the market has in the growth picture deriving from the Trump policies right now, okay? The picture can vary, the picture can change. Next week, we can be trading back up to 435, even why not higher? But in the meantime, the confidence numbers are such that, and the confidence in the market is that there is a bit of, you know, rebalancing going on as well. I mean, you get out of US bonds, or at least, yeah, no, sorry, I rephrase. The confidence is getting out a little bit of the market. So if you think about lower growth, there's not really a need for those yields to be much higher. So watch those differentials, I say. And there's another one that I'm going to show. And here is the opposite. Okay, UK yields were usually are usually trading higher than the European ones. But this is your euro sterling move. If you sometimes look for what's explaining moves, don't look too much further than these ones as well. I mean, part of your euro sterling move, obviously there is the confidence and whatever in Europe, but there is also a pretty sharp reduction in the differentials between UK and European yields. And euro sterling has responded to it because we are trading at highs of the euro sterling right now. So just this to bring you back to some of the pictures that I'm looking at to try and give me an idea of what's going on, what is it based on, where do we look, what are the correlations, where do we look for stuff to happen, okay? Right, euro dollar is where we broke it about those prior highs. And as you can see here, the next level is around 109.40. 109.40.50 would be a potential target for this move. But on the back of those rent comments, I have to say we were trading above 109 earlier, and on the back of those rent comments, the euro crosses have been losing some of their shine, and the euro dollar as well has shied away because we were really on our way to go and test the 109.40 here. Are we done? No. This still looks like just a bit of consolidation at high levels. And what I was showing in the room, and I also had a question regarding this on our social media platform. I was saying like, look, we are already building a little bit of really short-term support in the euro dollar. That still doesn't tell me that this move is done. So This support is now building somewhere in the 108.15, 15.20 zone. I think if we come back here, that's going to be for the intraday, for the short-term interest will be already a bit of an interesting zone. If we get below there, and if you confirm below 108 figure 5, there may be a little bit of a stop run coming, and we may see a bit of a move lower, okay? But then in the short term, you will see that there are already quite decent supports showing right below there. So what I think is 107.90, but I had one around here. Yeah, 107.60 was a bit of a springboard as well from where this last move started. So that's going to be your next move to watch on the downside. 109.40, 50 topside, okay? And then 109, well, call it 110. That's going to be pretty decent psychological level as well, this 110 if ever we get there. But will we get there today? We were musing about potential turnaround Tuesday in our room, but I would really say for as long as we stay above this 108, it's actually the line is coming up already. It's already around 108.30, which is the low of today. Really, if we stay above there, there's not too much reason. You can try and pick a little bit of a top leaning against that 109.40 perhaps. Maybe we'll have a look back down here, but for the time being, this is still quite bullish, especially if you look at the start of the move. We haven't seen too much of a give back yet. So this is how it looks right now. Cable, similar and not, because we have seen this euro sterling put in a big leg higher. It's actually coming back a little now. But we also have been consolidating the advance of the last week and a half in this 128.60, 129.40 zone. This is your little range to play with now, I would say. For as long as we are below 129.45, we could continue to trade this range. Okay. 128.50, 60 is really where it has to hold. If that holds, then it's just a little bit of an intermediate range, and we will likely see a 130 print, which I still think is possible. And then it's going to be case to see whether we can break those trend lines here, break those prior highs. This is a whole zone, right? 130, 130 and a half. I would be careful if we get up here, okay? It's another 80 points from where we are. I think on any US move coming in, seeing where the dollar is trading, that they could really go for a walk as well in euro dollar as in the cable. Those two, even with the euro sterling being beat, those two still look the most similar because it's like the European continent block, you know. If we start to get below 128 and a half, then we need to be a bit careful, because then we could be quite quickly retesting 128, the figure, why not coming back into the 127s. But for as long as this consolidates here, I am not inclined to counter trade this for now. Okay. Right. Let's look at what's happening in the yen, because it's been a very interesting night, and one that I did not expect to happen, to be honest. First of all, the dollar yen, okay? We've been trying a number of times now to get below 147, but it's very hesitant, very, very hesitant. There's an extra little zone here, or level here around 146 and a half that we have tagged last time as well. And it's holding, and it is all euro yen. I'm going to say it's all euro yen. It's all yen crosses, because the dollar yen doesn't seem to have a life of its own right now, despite higher JGB yields and dollar yields that don't move much. A bit of lack of confidence in the US, which we've seen as well over that last leg, but it's not going further. And the reason is this one here. And I'm first of all, well, okay, no, let's look at the longer term first. So longer term, not a lot has changed. Okay, longer term, not a lot has changed. We are now though back inside this daily cloud. We're actually just trying to get back in it. The top side is right around where the 200 DMA comes in at around 161 and a quarter, and the top trend line is still lying around 162 and a half. This is still, in my opinion, for the medium to longer term, an important zone. We could actually go there and then start to crash away, but be careful with it right now. Let me just look at the even longer term. No, we're not there, and that is a bit higher. Then, but let's go to the shorter term, and let me take the cloud out. Yesterday we had this drop over the past sessions. Sorry, we had this drop in the S&P, and I said like, well, the yen is plugged into the S&P rather or to US stocks rather than plugged into to yield differentials right now. And then look at what happened last night and overnight. This is a very counterintuitive move. I honestly was not expecting such a bounce here. Um, Especially Muto being in the States, potential. We don't have the assurance, I know, but potential that Japan is going to escape tariffs. That would be a tailwind for the Japanese yen. But we have absolutely annihilated this last move that we saw last from last week. We are really already nearly back there, you know, and that I didn't follow. I was quite fortunate to have a bit of a sleepless night and seeing that with all those equity markets coming down, this cross was like failing around here, not really breaking below 158.80. I didn't really. Oh, James, I actually missed that line. So James is saying, thank you for that. That the Japanese government says that they are not going to avoid tariffs based on their discussions with the US. I thought it was still more up in the air. Okay, that will then explain if the US will slap tariffs on Japan, this yen move. Okay, but still, with the US equities coming down, I would have expected this to trade lower. Okay, but it didn't work, so I cut my Euro yen shorts for now, and I'm in wait and see move. And well, yes, I mean on the back of that, I really missed that comment, and I'm sorry for that. And thank you, James, for reminding me. Um, so that explains this move. Then I completely missed that comment, but so you can see the importance that tariffs are still having on the currencies then. And this despite this big dump that we saw in the equity markets, because equity markets should really have been pushing this lower. So I really missed that comment, and that is the reason then why we are back up here. And also, I must say, I guess the market is already running short euro yen, because that was one of the trades that the market was looking at. Okay, look at, yeah, that's the thing. I mean, they did not get any assurance, and I'm reading the chat, and James is repeating that comment will be exempted, but it doesn't say that US will slap the tariffs. Okay, so I still think there's enough uncertainty, and they could still avoid it. But let's see. Yeah, I was talking about the Canadian dollar. And if you talk about the Canadian dollar, dollar CAD is not moving too much. Yes, we had um, Trump-related spikes and the uncertainty-related spikes surrounding tariffs, but the dollar CAD is consolidating, albeit at a relatively high level compared to where we were the past sessions. But this is still the uncertainty surrounding tariffs. But there's this little wrecking ball, as I said, euro. And whatever euro cross you look at, euro commodities, euro CAD, it's the euro is really doing a lot of heavy lifting there. So since we broke above this little wedge, it did not look back, and we're already at next potential big targets. This is a pretty big um, traffic zone here in the euro cat for those who are watching it, between 156.5 and 157.85 or 80, call it 158, and we're in the zone. Okay, so I'd say pay attention to what's happening. And especially I would say it's going to depend now on euro strength, and it's going to depend on euro strength for a lot of those euro crosses. Because look at the euro Aussie, they did the same thing. The runaway break easily broke above prior highs, and I said we could be on our way to 175s. We are on our way there, but watch for any euro-induced moves, okay? Because if we get like adverse um, adverse news surrounding that spending or so, all those euro crosses could get a little bit of a knock on the head, okay? So be uh, be a bit careful with what's happening here because we are moving in a lot of those euro crosses on thin air. And to talk about the euro cross, I got stopped out on my small euro sterling short. But we are already coming back in here in there. This is perhaps one that I would perhaps be tempted to try again. But since this is my last day in the office before a few weeks off, I'm perhaps going to let it for what it is right now, unless we start to move back below perhaps 80 for the figure or so, and then put a bit of a more medium-term trade in there. But this is another one that I was showing earlier on the differentials between the EU and the UK rates that tried to break up. But this is less, um, I would say, less obvious because EU and UK could actually work together in those at least in parts for the defense spending and stuff, and they are trying to yeah, I mean, find some agreements to help Ukraine and up their defense at the same time. UK is not going to spend as much money as the EU at all, but it could have just the sterling and the euro walk together for a while. This is still a possibility. In which case, we may just find resistance and perhaps trade a bit more sideways. Who knows? Um, Aussie and Kiwi. Laggards, 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 laggards. Really, the Aussie can't get off the ground. Well, that confidence number won't have helped either overnight. But really, I mean, it's a really big laggard. I don't know what to do with this, but just observe those ranges and just remind yourself that we are going to for this to go back up to 64. We are going to have to break 63.30 and hold it. Okay, I mean this is not enough. We always rejected those moves here. This is not enough. So for me, this is still looking amidst the weaker ones that we are seeing. Kiwi is in a similar situation, but holding up a little better than the Aussie. So I would argue that one, Aussie Kiwi testifying obviously of the Kiwi holding a little bit better. I would say that one doesn't need as much. I think already a move back above 57.20 could see a little bit of a move higher. Now, turnaround Tuesday for the dollar, who knows if we start to get below 56.75, which is the closest decent or half decent support, I would say. There is a potential that we get down to low 56s before reassessing. In the meantime, I'd say this one is holding a little bit better than the Aussie. Gold, we had a quick move below that range that we traded for a while, but already around 28.80, we are finding support. I thought a break below, yeah, 28.80. Had it been marked down, but I thought that there would have been a possibility to go down in 28.60s, where I would have been interested or so. But we are already getting back up. So still tells me that there is still demand for it. When it happened was again the Asian session. Asians have been quiet for a while, but the Asian session saw demand for gold. So that's always an interesting one to look at. So the rest 28.80, 28.60. Top side again, same zone, yeah, 29.20, 29.30. If that goes, then we can have a look back up to prior highs, in my opinion. But we have to respect that zone in gold, okay? And so I'm going to just going to show you that Noki Stocky again. It is trying to find a little bit of a bounce. Quite happy about this. This is one that I'm going to run now. For as long as we are above 92.80, 92.10, I'm going to try to defend this position. I've entered a little bit of a long on the Noki Stocky. I am going to, as per usual, take partial profits into resistances, but we may just have found a bit of a bottom here in the Noki Stocky. It would be encouraging if we start to move back above 90.95. Okay, and then the two last ones for the road, and then I'm going to call it a show. So we had the break in the S&P through 56.75. We are forming a little bit, there is a little bit of a zone here, okay? Yes, the bigger level is 56.75, undeniably, but there's also the 50% of this last leg higher, which comes in at 56.16, where we are just trading above right now. Not too sure what's going to happen this afternoon with the US when the US walks in, but a little bit of a zone where we can try to figure out what's going to happen next. Next could be a move back up to 57, 40, 60, 40, 70, or a test of this 61.8 at 5,500. Bigger levels are waiting, and I would say 5,300 to 5,360. That's going to be a much bigger zone for me if we see an extra decline, okay? If we start to move back above 57, 40, 60, I think this was just another dream for the bears, and we can move higher again. Nasdaq broken, okay? We've broken 19.75, broken 19.5, went down to the 61.8 of the move at 19,100s. We are also bouncing, and we are back in this 19.5 zone. So the level is relatively clear here, 19.75. If you move back above, we could have a look back at the 200 DMA about around 20,300. If we break below the 61.8, I guess we are on our way to 18,300. So the levels are relatively clear to me, but for the time being, we are clearly trading a lack of confidence in what's happening stateside, whether it's layoffs, whether it is lack of confidence in the Max 7, lack of confidence in Musk, lack of confidence in Trump's policies, you name it. But the market is in a rebalancing mode between US equities and other equities, and other equities are especially the European equities, of course. But there is lack of confidence now. Now, again, if we start to move up again, if you move above 20,300, I think this correction may be over, and then we start to climb higher again. Never rule it out. We've seen those kind of setbacks and then start to move to new highs. We've seen them all in, maybe not in such a big way, but we have seen those big setbacks, okay? And we still move to new highs, all right? So if you look at the bigger picture, all right, we are still not at the 38.2, which only comes in the 17,800 zone. Okay, so these are still retracements. Okay, right, that's it for me. I'm going to wish you an excellent few weeks. I'm taking off. I'm going to see my grandson in Japan for a few weeks, and I shall talk to you start of April again. Be good, everybody. Thanks a lot for coming to the Flow Show as ever, and I talk to you soon.